So till now in accounting we have talked about three things. First of all, we have understood the meaning of accounting, the meaning of accountancy as well as bookkeeping. Then we understood certain basic accounting terms like drawings, like assets, liabilities, profits, losses, all those things. And thirdly, we talked about important accounting principles and concepts which were very important for the examination. In this particular lecture, we are going to talk about certain debit and credit rules, which are very important if you want to understand accounting from the purest sense, and questions from these areas also have been asked in the examination. So let's talk about classification of accounts and understand how accounts can be classified, and then we'll take it forward and practice certain questions. The three classifications are number one, personal account, number two, nominal account, and number three, real account. So just remember all these three classifications, three elements: personal, real, and nominal. Let's talk about personal accounts first. What are personal accounts? Personal accounts are those accounts which are dealing with the following: individuals. For example, if a certain person, for example, if let's say Himani takes a loan from Corporation Hero Corp. Hero Corp gives a loan to Himani of rupees 10,000. So this is an individual account because this is related to an individual whose name is Himani. Firms, yes, again. So Hero Corp is also a personal account. The account of Hero Corp is also going to be a personal account. So Himani's account will be called as Himani account. It's very simple. Hero Corp's account will be called as Hero Corporation account, and both of these are personal accounts. Companies, debtors or creditors. So people who borrow money or who lend you money, if they're individuals, that is also a personal account. Clubs as well as cooperative societies. So all these are personal accounts. What is the rule when we are dealing with personal accounts? The rule is you debit the receiver and you credit the giver. For example, here what is going to happen is if Himani borrows 10,000 from Hero Corp, then the accounting transaction that is going to take place is Himani account debit to whatever is credited is called as to Hero Corp account. Why is this accounting transaction taking place like this, and what is the meaning? Himani account debited. Himani's account has been debited because she's a receiver and it is a personal account. So you're debiting the receiver and you are crediting the giver. To Hero Corp account. When you are placing to before any account, that means that it has been credited. So the giver has been credited and the receiver has been debited. This is the accounting transaction that you need to remember. This is the journal entry that has been entered, and based on this journal entry we are going to create accounts for all these different journal entries and different transactions that take place in the organization. So for now you just need to remember that there is a account called as personal account, a classification called as personal account, in which all these elements come, and the rule is that you debit the receiver and you credit the giver. The next one is called as real account. In real account, the classification is, or the elements of real account are tangible as well as intangible assets. Whatever assets are there in the organization, whether long term or short term, all of them are going to become a part of real account. Land, because it is an asset. Building is also an asset. Investments are also assets for the organization. Plant and machinery, long term or fixed asset. Stock is also a current asset, and cash in hand or cash in bank is also a current asset. So whatever kinds of assets are there for the organization, all of them become a part of real account. What is the rule? The rule is debit what comes in and credit what goes out. For example, Himani sells her, let's say she has a Mercedes and she sells her Mercedes for, let's say, 10 lakh rupees. So she sells her Mercedes for 10 lakh rupees. So what is going to happen is she is going to receive cash. Now cash is a real account, therefore cash is going to be debited because you debit whatever comes in. She has received 10 lakh cash, therefore 10 lakh cash is to be debited. And what has gone out? Mercedes has gone out. Mercedes again is a real account because Mercedes is a part of plant and machinery because it is a fixed asset. So Mercedes has gone out, therefore Mercedes is going to be credited with the same amount, 10 lakh rupees. So you debit cash and you credit Mercedes. In this particular transaction, you're not debiting or crediting Himani at all, because Himani is a personal account and not a real account. Real account which are involved here are cash as well as Mercedes. So these two accounts are connected and related and affected in this particular transaction, and therefore this is the rule that you're going to apply, that you debit whatever comes in and you credit whatever goes out. And the third one is called as nominal account. Very important to understand and remember. These are the elements of nominal account: revenue as well as expenses. Whatever revenues are earned by an organization, whatever expenses are incurred, losses and gains, salary account, purchase account, interest paid account, sales account, commission account. All these are expenses or earnings, and therefore they all become part of nominal account. The rule is you debit expenses and losses and you credit incomes and gains. So whatever expenses are incurred and losses are incurred, those are debited, and whatever incomes are made, those are credited. Let us take an example. So let's say there is a company called as XYZ Private Limited. Now XYZ decides to pay salary to its employee. The accumulated salary is, let's say, 1 lakh rupees for all its employees. Now what is going to happen? It is going to pay salary. So first, salary account is going to be affected. Second, how is it going to pay salary? It is going to pay salary in cash. So cash account is also going to be affected. So now we have determined that these two accounts are going to be affected. Salary account is a nominal account. On the other hand, cash account is a real account, as we've already understood. So cash account is a real account, salary account is a nominal account. What is the transaction? What is the accounting transaction or journal entry that is going to be carried out? According to nominal account, you debit all the expenses and losses. So salary account is going to be debited. Salary account. 2. Why are you going to credit cash? Credit incomes and gains in nominal account, but this cash account is a real account. In real account, what happens? Whatever goes out is credited. Therefore, because cash is going out, therefore you're going to credit it. So what are the three rules? Nominal account, debit all expenses and losses and credit all incomes and gains. Real account, debit what comes in, credit what goes out. Personal account, debit the receiver and credit the giver. These are the three rules that you need to remember, and if you are able to remember all these three rules, you can solve any question which comes your way related to accounting transactions. Let's take certain examples to understand them better. Every transaction has two effects, one on debit side and one on credit side. We'll understand this. We have been taking certain journal entries and we'll be able to understand it better. Money received from owners of business as capital. Very typical and very difficult first example itself. The question is money received from owners as owners of business as capital. So this is a business, let's say XYZ Private Limited, and the owners are A, B and C. These are the three owners. These three owners decided to contribute to this business when they started this business a total sum of 10,000. So they decided, let us put in 10,000 rupees to this business and start running the business. So what is going to happen? The XYZ company private limited is going to receive cash. Cash is going to be received. So in the books of accounts of XYZ limited, what is going to happen? Cash is going to come in. Cash is a real account. In a real account, what is the rule? You debit whatever comes in. What is coming in? Cash is coming in. Therefore, you are going to debit cash account. Cash account is going to be debited, DR. Now, what is the other account that is affected? Because they have given loan to this XYZ Private Limited, whatever money they have put in, they are going to take it out someday. They have given a loan to this company, which is a liability, and this liability is called as capital. This liability is called as capital. And when this liability increases from the owners, we are going to use it as a personal account. Capital is a personal account. So what is going to happen? A, B and C, because they are people, so it's a personal account. And what is the rule in personal account? You debit the receiver, but you credit the giver. Who is the giver here? The giver is A, B and C, and therefore because they are giving to the organization, they are going to be credited. So you debit cash account and you credit ABC's account as capital because they are owners of the company. Rather than writing ABC, we write capital. And what is the sum of money? 10,000 is the sum of money that is involved. So this is how we are going to deal with the first example. Let's have a look at the second example. Purchase of machinery for business. So you're purchasing, the business is purchasing machinery. Let's understand it. XYZ Private Limited is, let's assume, the business. It purchases machinery. So what comes in? Machinery comes in. Machinery comes in. Machinery is a real account. It's not a personal account. It's not a nominal account. Whatever comes in as per real account, you debit it. So you are going to debit machinery account. What goes out? Because it is purchasing machinery, it is going to pay in cash. Cash account is again a real account, and when cash decreases or real account decreases and or goes out, what you do? You credit it. So both the accounts which are involved here are real accounts. What you're going to do is debit machinery account. So you debit it and you credit cash account. You credit it. Both the accounts are real accounts which are involved here. One is debited because it is coming in, and one is credited because it is going out. Let's have a look at another example, very good example. Dinesh started a business with cash rupees 5 lakh. So this is equivalent to the capital example that we just had a look with. So Dinesh here is a personal account. It is going to be credited, and because cash is going to be received, so cash is going to be debited. Borrowed from Himani rupees 10,000. So this particular organization now borrowed money from another person. Who? Himani. Himani is a personal account, not a real account. It's a personal account, and the rule is you debit the receiver and you credit the giver. And because he's a giver here, she's a giver here, you are going to credit her. And what did you receive? You received cash, and therefore you're going to debit cash because it is a real account. Purchased furniture from Raj Furniture in cash for rupees 20,000. So you purchased furniture. What is coming in? Furniture is coming in. What is a furniture? Furniture is an asset. It is a real account. Whatever comes in as per real accounts is to be debited. Cash, again, another real account which is affected here. It is going to be credited because it is going out. So these are the transactions or journal entries that you are going to make. You're going to debit one thing, and with an equivalent amount, you're going to credit another thing. So these are basic credit and debit rules which were important.